people to call the show that are genuinely interested in increasing their financial IQ so that they can become financially independent sooner and stay financially independent longer.
Fred Snyder.
You don't have a blueprint. Imagine trying to build a house without a blueprint. And how about having a blueprint for your life? What are your lifestyle goals? You need to think about your family life. What are your goals about your family life? What are your lifestyle goals when it comes to health? What are your lifestyle goals when it comes to finances, mental and spiritual? You have to set goals in all those areas, not just finances.
Fred Snyder.
Often we fail because we put too much emphasis on one area and ignore everything else. We work our butts off and we ruin our health. So life is all about balance. So you need a life plan.
Fred Snyder.
Napoleon Hill says this, wrote the book Think and Grow Rich. Anything that you can vividly imagine, ardently desire, and enthusiastically act upon will inevitably come to pass.
Fred Snyder.
My goal, my mission is to help people enhance their financial IQs by teaching them what they need to know to make better financial decisions.
Fred Snyder. Sunday mornings at 9 on AM 650.
The following is a paid program on AM 650.
Now, AM 650 presents It's Your Money, an up-close and personal look at your finances. Here's your host, Fred Snyder.
Up in the morning and out to school.
Okay, we're back. Again, we are live, we are interactive. We're here to talk about your money, more importantly about your money and how to keep it. And we welcome your calls. The number to call is area code 604-280-0650. If you're calling long distance, it's 877-280-0650. Frida's down at the office. As usual, for those who are shy, reluctant to talk on the air, area code 604-737-3512. If you're calling long distance, it's 800-661-1495. Ask yourself this question. How long have I worked? How much money have I made? How much of that do I have left today? And are you happy with the answers? And the chances are you are not. Met very few people during my career that are happy with the answers to those questions. So it's time to do better. And the way you'll do better is to acquire some financial knowledge. The way to do better is to elevate your financial IQ. Listening to this program, reading books, and other methods of financial education are always a good idea. Your success when it comes to financial matters, your elevation, your altitude really depends on your attitude when it comes to knowledge. So it's time to get some knowledge. So call in with your question, call in with your comments, get yourself a written financial plan, no cost or obligation. Get yourself an MRI on your investment portfolio, no cost or obligation. We're going to do a sample MRI here today on this show. You can log on and watch that live if you wish. www.am650radio.com and click on Watch TV. Once again, I emphasize the fact that Frida works on Sundays down at the office. Hence, she doesn't work on Fridays. She's down there virtually all day today. So you want to make an appointment to see myself. You have a question or a comment, you can talk directly to Frida. Area code 604-737-3512. If you're calling long distance, it's 604-280-0650. Want to once again talk to you about your money and how to keep it. If you look forward in life, statistically speaking, if you take 100 people who started equal today at the age of 25, 100 people who are 25 years of age today, by the time they end up at 65, one is wealthy. One. 5 are well-to-do. 5 are still working, 36 are dead, and the remaining 54 are dead broke, dependent on family and state. So we talked about the past, the fact that you spent just about everything that you earned, not happy with how much you've accumulated. The future doesn't look very good either. And the difference between the past and the future, the way to bring them together is to get yourself a proper, well-designed, written financial plan. We offer that at no cost or obligation. All you need to do is make a phone call. So again, if you just tuned in, I'm certified financial planner Fred Snyder, also a registered financial planner representing Scotia McLeod, also representing financial education. That's my mission. My raison d'etre is to teach people what they need to know to make better financial decisions. So again, log on, get on the line, give us a call. Let's talk about your money, but more importantly about your money and how to keep it. So I'm going to go straight to our case study here for today. And again, there's different sections to this case study, but this is an actual case study, and I'm going to jump to what I call my comparison index. I'm going to look at what the client already has, a benchmark which we can compare that to, and then a replacement portfolio, and then a comparison of the whole three, side-by-side comparison. So in other words, the elements that we investigate when we look at a financial plan are your strategic asset allocation. Now, I know that term strategic asset allocation is overwhelming to a lot of people. They don't understand what it means. That simply is your asset mix. That answers the question, how much money do I have in cash? How much money do I have in fixed income investments? And how much money do I have in equities? And how much should I have? So your strategic asset allocation, we have a table and we have charts and so on. We also, when it comes to asset allocation, we have the geographic mix. You've heard the old saying that you shouldn't put all your eggs in one basket. Well, you shouldn't invest all your money in Canada, all your money in the United States, or any singular place. You've got to spread it around. So we have the geographic asset allocation, the sector asset allocation. How much money is invested in financial institutions? How much money is in industrials? How much is in energy and so on? What is the overall mix? We're going to take a look at all that. We're going to look at the compound rates of return that the particular portfolio that currently exists has generated. And again, I got a real problem here with my computer. It has just taken over on me, and I've lost. Anyway, I'm just going to have to wing it because I got to wait for this stupid computer. This is terrible. I don't know what happened. I don't know why that kicked in. I'm going to sue Bill Gates. So again, you're out there, you're listening to the show. You want to talk about your portfolio. You want to talk about your asset allocation. Get on the line and give us a call. Once again, how much money do you have invested in cash? How much money do you have invested in fixed income? And how much money do you have invested in equities? You need to know that. And you need to know what it should be and what it is. You need to be able to take a look at your portfolio, and you need to be able to say, this is how it compares. This is how it compares to a benchmark. This is how it compares to the portfolio that you're recommending to replace the one that I have right now. So you have to look inside that. You have to analyze that particular portfolio and look at it and say, is this the right way to do it? And you know, percentage of the time, maybe 5% of the time people come to see me, maybe a little more, maybe a little less, but not very often when people come in to see me do they have their portfolio set up so that it's optimal. And you really need to worry about that because this is your financial future. This may be your retirement plan. It may be your RIF. It may be your cash account. How much money should you have invested in Canada? How much money should you have invested in the United States? These are important questions, and maybe you might want to phone in with those questions. Get on the line and give us a call. In the meantime, we have Peter from Burnaby. Peter, I'm winging it here right now. I've just lost my computer, but help me. Welcome to the show, Peter.
Well, thank you very much. It's good listening. I'm watching the game on one side and listening to you on the other side here.
Well, that's good competition.
Anyway, I was listening to you last week, and you were saying that you had two properties, and you deemed one property your primary residence
yes.
over the other. Now, I've run into a situation where I'm not eligible for the basic grant in one home, but in the other home I probably still could. But I don't know, what do I need to prove that this is my primary residence?
I don't think you need to prove anything. I think you can just you don't have to live in it to call it your primary residence. So a lot of people don't understand that.
Yeah.
You can't rent it and call it your primary residence, but you don't necessarily have to live in it. If you rent it out, it becomes rental property, and they have what they call change of use rules, which means it's rental property and it can't be your primary residence. But if you have two houses, you have a place at Whistler, you don't live in it, you don't rent it out, and you got a house here, you can call the either one or the other your principal residence.
So it's just a matter of filling out the forms.
Yeah, you designate it to be your principal residence. Yeah.
Okay.
And I'm sure that's the way it works.
Okay.
You know, you could have I have an existing client that had a place at Horseshoe Bay that at one time had a market value of about 12, 13 million. And anyway, the property got run down and the value of the property dropped to about 4 million. But these people bought another place in Vancouver, and they deemed Horseshoe Bay to be their principal residence because from a tax point of view, that was the better place.
Yeah. And I think that's what we're going to have to do.
And again, that all should be part, Peter, that all should be part of a written financial plan.
Yeah, and we're in the process of doing that. Unfortunately, we're very close to retirement, and it's a little late in the game to do this, but it will have to be done.
Whether you're in retirement, close to retirement, or a long way from retirement, everybody needs a financial plan. And if you want to call Frida, you get one from me at no cost simply because you called the show.
That'd be great.
So if somebody else is preparing one, you can compare the two.
Will do. Well, thank you very much.
Peter, you can reach Frida right now at area code 604-737-3512.
I'll give her a call.
Give her a call. I appreciate your call, and enjoy the rest of the weekend.
You too.
Okay, bye-bye.
Bye-bye.
Okay, Peter's line is now open, so if you're out there, get on the line and give us a call. I'm winging it here right now while I get my computer back to first base here. Bill Gates, he sneaked in there and he did a restart on me right in the middle of everything. I've never had that happen in my entire life. So I don't know how that happened. I must have configured my computer somehow or another to do an update behind my back when I wasn't expecting it. So again, we're talking about your money, more importantly about your money, how to keep it, and we're primarily talking about what you have right now. So let's suppose that right now you have a portfolio, and you don't know if it's a good one or a bad one. You don't know if it's somewhere in between. You don't know if it's going to work or not work. You're worried about whether you're going to have enough money to retire or not. You don't even know. I run into these situations endlessly. You haven't got the foggiest idea how much retirement income you need, how much retirement income you're going to have, how long your money's going to last, the rate of return that you're getting on your investments. Are your investments safe or risky? You don't know any of that. If that's you, you need financial education. If that's you, you need a written financial plan. If that's you, you need a well-qualified financial advisor, if that's you. And you start that process simply by having the courage to make a phone call. The number to call is area code 604-280-0650. If you're calling long distance, it's 877-280-0650. If you want to log on and see us live struggling with this computer, you can do that. www.am650radio.com and click on Watch TV. Or if you're shy or reluctant to talk on the air, you don't want to do any of that, you can call Frida. Frida's down at the office right now. You can reach her immediately at area code 604-737-3512. If you're calling long distance, it's 800-661-1495. So again, you can send me an email. Email is fsnyder@mutualfund101.com. Send me an email. Maybe you have a question or a comment. Appreciate it very much and appreciate your participation in the show. Again, we're talking about your money, more importantly about your money and how to keep it. So I'll see if I can get logged on here. Hopefully that works. No, I mistyped it. I can't talk and chew gum at the same time, I guess. Try once again. That worked that time. Okay, bingo. So again, you're out there, you're listening to the show, you're worried about your investments, you don't have a financial plan, you don't have a financial advisor, you don't know if your investments are going to work or not, you don't know what's going to happen if your investments get hit with another market meltdown like we had back in 2008. You're worried about all that. You're thinking, gee, I wish I'd have bought one of those GLWB products. GLWB stands for Guaranteed Lifetime Withdrawal Benefit Programs. Many insurance companies offer them. They're coming back right now, so you might be interested in one of those. You might be interested in a pension plan. You might be interested in a financial plan for yourself or your... no, it's coming. It's working. Wow, what do you know? Anyway, we're talking about your money, more importantly about your money and how to keep it, and I don't know what's still going. Oh, there we are. We're up and running. How about that? We got Bernard in Richmond on the line. Bernard, welcome to the program.
Hey, Fred. How are you doing this morning?
I'm having a struggle with my computer. I had everything all set up. I got here early. I set it up all beautifully. All I had to do was a click here and a click there, and everything was fired up. And Bill Gates jumped in and did a restart.
Well, that's the way it sometimes works in our financial planning lives, too. You know, you think have it all taken care of, and then all of a sudden 2008 comes along.
Yeah. Unbelievable, this stuff, you know. It really is.
Yeah.
So,
But, you know, you just got to keep things simple. Pen and paperwork, wonderful still.
back in the old days, they sure did, and I was longing for the old days, I guess. But there's no way, you know, it's a funny thing, but what's happening right now, it looks like it's loading everything back the way it was, all by itself.
You got that right. More and more.
What can I do for you, Bernard?
Well, it's just more and more like, you know, how our government was able to take the penny away from us, you know?
Mm-hmm.
I mean, that's amazing when you think about how many pennies are spent every day or could have been. And there was an alternative to that, is you could have a 1-cent stamp given away every day so that every year when you collect enough stamps, you could send off your income tax every year.
Well, that sounds like a plan.
Well, it's much better than taking our penny away. I mean, when I was a kid, I used to have a piggy bank, didn't you? How many kids had that? We don't even do that anymore. So the problem is we just kept saving them. We never did invest them.
Well, how about that? It looks like...
Still having some technical difficulties.
I honestly, I don't know what's going on here now. I'm not sure what to do, and I can't do a radio show and do the deep thinking that's required. I might mess the whole thing up real royally, but I think we're okay.
Thank you for turning me on to Dr. Don Nixford. He's an amazing doctor, chiropractor. You know, was really good.
He was on my show last week, yeah.
I know. Amazing guy. You know, I really appreciate him, what he's done for my back. It's really helped a lot. I was going through some pain, and he's relieved a lot of it, and he's done something different from most chiropractors do. But and you're going on the fishing trip again, Fred?
Oh, I presume so, yeah. Mm-hmm.
Okay. Are you giving a little plug for the trip that you do every year?
Well, if anybody likes to fish, I'm sure there's a few spots still available on the Edgewater Fortune, which goes up north, about 10 miles south of Bella Bella or Shearwater, and the fishing is absolutely unbelievable. You went a few years ago, and you did all kinds of photography on that trip, and you can bear testimony. You didn't like fishing, so you just took pictures. But what are your comments? Is it worthwhile?
Well, if you're a fisherman, it's great, but I still think you would be better off giving away a cruise and putting a seminar on it for most people. Not everyone's a real fishing fanatic like yourself, Fred.
No, but I'm not promoting cruises. I'm right now promoting a fishing trip, and you're promoting a cruise. So we're going in two different directions. You're going south, and I'm going north.
No, I know, but I enjoyed the fishing trip. It was interesting, but I'm not a really fanatical fisherman like yourself. That's all I'm saying.
I know, but there are those out there that are.
Oh, for sure.
And we're fishing for those guys.
Oh, I know, and it is a fantastic trip for those guys because you could put your boat on top of a huge ship that goes up there, and they feed you well. They're really good people. They look after you. And great people. I was really pleased to have a week with you and learn a lot and get mentored by you, Fred. It's I will always remember that for the rest of my life, is meeting you and your son. And there was a couple other people I met up there. There was a Ralph, and just really good people, you know. So had a great time. And I'm hoping you're going to be putting on some courses again in September. Is anything happening there for your audience?
Well, as far as the courses in September is concerned, I've had a multitude of requests to restart them up. But what I'm doing right now, I'm in the process of formatting, and I'm not going to do anything until I get it finished. 20 case studies, which I'm trying to do here today, and that will be the content of my workshops going forward. They'll all be case study format. And what makes them unique is that some of those case studies involve people with $100,000 to invest. Some of those case studies involve people that have $2 million to invest and even more. So we got large investors and small investors and actual real live case studies. We've removed the name from them, so there's nobody identified, but they are actual real case situations where somebody came in with a portfolio which was poorly constructed, poorly diversified, performance was terrible, risk was high, didn't fit their circumstances at all. It could very well be said to be extremely unsuitable for that particular client. That's what they had. They were looking for a second opinion. So we took that portfolio, we analyzed it according to all kinds of different criteria, and then we compared that to a benchmark. Because really, when you say, how well am I doing, the real question is, how well am I doing compared to what? Because you got to compare everything. So,
Yes.
so we compare it to a benchmark, which would be similar in content to the Canada Pension Plan. And then we compare it to a model portfolio that we would offer as a replacement to the existing one. And you can see how they compare. And most of the time, not all the time, but most of the time, the model portfolio wins. Most of the time, you look at people's portfolios. Here's what is wrong with most portfolios that I look at. They're too risky, or they're not risky enough. So the risk isn't exactly the way it should be. They're poorly diversified. They don't have enough international exposure. They're all invested in Canada. By sector, they're poorly diversified. They have too much money in financial institutions and not enough money in other sectors. They're hard to understand. And most importantly, the investments chosen to satisfy the structure of the portfolio are not the best investment funds. And there is something out there, somewhere around 20,000, I think it's 2,200 investment funds available out there, and it's a minefield to try to pick the best ones. Bernard, you ought to be able to take your investment statement and put it on a table in front of you and put your finger on it, blindfold you, put your finger down on it anywhere, and it's going to land on one of your investments and say, this is why I own this investment. And most people can't do that.
Well, thanks to you, Fred, I do have a written financial plan. Not many people out there do, but that was an excellent day that we had at your workshop where we went over step by step on how to write up a financial plan. And then you had your assistant crunch the numbers for us in a nice little spreadsheet and everything, and it just looks really excellent. You just see where you're at.
Do you have an updated version of Excel on your computer, the latest?
You know, I'm not up to date to the computers as much as you, Fred. But
well, anybody listening to the show, this is for anybody's benefit. Anybody listening to the show, if you open up a blank Excel worksheet, and this is the latest, the first worksheet that shows up there as a blank template is a retirement calculator. It's the exact one that I use. So it's right available. You buy it with your software. There's another one on there that does a budget. So you want to do your financial plan. A financial plan, really, the heart of a financial plan is a budget. A budget as the numbers stand today, a budget as the numbers should be, and a budget as the way the numbers will be after you retire. So you got three scenarios. You got three budgets. The way it is now, the way it should be, and the way it will be after you retire. Three sets of numbers. And basically, a budget is how much money's coming in and how much am I spending. And the difference is called cash flow. Is your cash flow positive, negative, or neutral? If your cash flow is neutral, then you don't have any money to save and invest. If it's positive, the difference should be accumulating in your bank account or your mutual funds or into your investment program. If it's negative, you got a real problem because that means you're going south instead of north. Okay, you're going in the exact opposite direction because if you have a deficit, it means you're spending more than you're earning, and the only place that spending can come from is out of savings, investments, or by borrowing it. So if you decrease your net worth or you increase your liabilities, you're decreasing your net worth automatically. So a deficit is a no-no. So if you do a budget and you have a deficit, you have to fix it. Some of the ways to fix it are, am I paying too much for the wrong kind of life insurance? Is my interest expense on my credit cards and my mortgage and all that. Is it tax deductible? Am I spending too much on groceries? Maybe I'm spending too much because I just don't budget. I don't have a budget. Maybe that's the problem, okay?
Yeah.
So
what I like to look at, Fred, is when you're planning your retirement, I kind of like to visualize a lifetime vacation that you're planning for. And, that's the way I look at it in my life. We're on one way of vacation when retirement comes.
Or, sometimes, some people say, well, I really don't want to retire. I get paid well for what I love to do.
Mm-hmm.
I mean, that's just another way to look at it. Some people don't want to work. That's fine. You don't want to work. That's great. But I like my job. I like what I do. I enjoy it a lot.
I know you're in your element, Fred, like the captain of a cruise ship.
Maybe that's what I should buy myself a cruise ship and take people cruising and do financial seminars on the cruise ship.
Well, that would be the be-all,
If anybody has any connections with the cruise ship, I would love to do a financial seminar on a cruise ship.
Well, maybe we could work on that. Get some input from your callers, how they would rather go on a cruise or would rather go on a fishing trip. I'd say
you could make an argument that if somebody went on a cruise and they attended a seminar while on the cruise, that a portion of that cruise could be tax deductible.
Well, if David Ingram was around today, he would definitely probably concur with that.
So bottom line is that we're talking about your money, but more importantly, how to keep it. Your money and how to keep it. How to keep it is where we fail. Every one of us during our lifetimes will earn a small fortune. Most of us will spend it all. And we don't keep any of it because we don't have the will, we don't have the plan to do it, we don't have the education to do it, we're afraid. The word fear, the acronym FEAR, is false evidence appearing real. So the opposite of that is knowledge. You want to overcome fear, you need knowledge. If you're afraid to talk to your financial advisor because you're afraid to look in the mirror, you may be afraid to see things as they really are, but you got to do that.
And one of your great things, Fred, is most people don't plan to fail; they just fail to plan. And I'm going to leave you with that, Fred. But all the best to you.
That's a powerful thought.
And happy Father's Day. If all I know, if you were my father, I'd be very proud to have you as a father. And I look at you as a mentor, and I figure I just wanted to honor with you that, Fred.
Bernard,
God bless you and your family.
I can't tell you how much I appreciate that, and same to you.
Okay. All the best, Fred.
Enjoy the rest of the weekend. Take care. Bye for now. Okay, if you just joined us, Bernard's line is now open, and I'm certified financial planner Fred Snyder, also a registered financial planner representing Scotia McLeod. We're talking about your money, more importantly about your money, how to keep it. My computer failed a minute ago, and I think I'm going to go to the break if I can, because maybe I can get the rest of my computer set up where we can continue where we left off. So I'm going to go to the break, and when we come back, we'll continue with the case study. Don't go away.
Fred Snyder.
I want people to call the show that are genuinely interested in increasing their financial IQ so that they can become financially independent sooner and stay financially independent longer.
Fred Snyder.
You don't have a blueprint. Imagine trying to build a house without a blueprint. And how about having a blueprint for your life? What are your lifestyle goals? You need to think about your family life. What are your goals about your family life? What are your lifestyle goals when it comes to health? What are your lifestyle goals when it comes to finances, mental and spiritual? You have to set goals in all those areas, not just finances.
Fred Snyder.
Often we fail because we put too much emphasis on one area and ignore everything else. We work our butts off and we ruin our health. So life is all about balance. So you need a life plan.
Fred Snyder.
Napoleon Hill says this, wrote the book Think and Grow Rich. Anything that you can vividly imagine, ardently desire, and enthusiastically act upon will inevitably come to pass.
Fred Snyder.
My goal, my mission is to help people enhance their financial IQs by teaching them what they need to know to make better financial decisions.
Fred Snyder. Sunday mornings at 9 on AM 650. This is CISL Vancouver. All-time favorites. AM 650. You're listening to It's Your Money on AM 650. Once again, here is Fred Snyder.
Okay, we're back, we're live, we're interactive, and I think we're back to where we left off, so hopefully I won't have to go ever through that again. That was painful. But anyway, here we have the holdings in this particular case study. Particular client involved, this is, again, I remind you, this is a live case study. It's a real one. This particular person has these investments: Blue Bay Global Monthly Income Fund, Phillips Hager North Canadian Equity Value Fund, PH&N Canadian Money Market Fund, PH&N Currency Hedged Overseas Fund, PH&N Dividend Income Fund, PH&N High Yield Bond Fund, and so on. Now, all these investments are basically RBC. Okay, so the person is not diversified by company. In the model portfolio that I offer as an alternative to this, I'm dealing with 5 different companies, not just one. Okay? I'm not saying there's anything necessarily wrong with dealing with one company, but you've heard the old saying, you don't put all your eggs in one basket. Now, this is a real case study. So here's the benchmark that we compare it with. We have iShares Canadian Universal Bond Index Fund, 40%. And we have iShares Standard & Poor's TSA, or TSX, I should say, Cap Composite Index, 60%. That is similar to the Canada Pension Plan structure. So we're comparing that to that. And last but not least, this is model portfolio 7.5, and we have Dynamic Energy Income Fund. We have Dynamic Global Infrastructure Fund. That's one company, 2 funds. We have Mackenzie U.S. Growth Fund. That's 5% of the portfolio. That's a third company. That's one company, 2 companies, I should say. This is RBC Canadian Equity Income Fund for 20% of the portfolio. That's an RBC fund. Second RBC fund is RBC Global High Yield Bond Fund. Then we have Century Small Mid Cap. That's 35% or 3% of the portfolio. We have TD Canadian Bond Fund. We have TD Entertainment and Communication. We have TD Health Sciences. And we have TD Short-Term Bond Fund. 5 different companies, not one, 5, well diversified through every sector. And every one of those funds is a top performer in its particular classification. So which of those portfolios would you rather have, the more diversified one or the less diversified one? Pretty clear, I think. Okay? So we look at the holdings, and then we look at the geographical diversification in the portfolio. So again, there's a table which shows the geographical diversification, but I believe that a picture is worth 1,000 words, much easier to understand. So how much money do we have in Canada, the UK, Netherlands, and so on across the scale there? Well, when we look at the money that's in Canada, we have almost 60% of the money invested in Canada. The benchmark is 100% in Canada. And my Canadian exposure would be about the same. So that's okay in that particular case. We go across, though, and we don't have enough money in any of these other areas to make any difference at all. We get to the United States, and we have about 22% or so. It's actually 23.67 in the United States, actually 36.47. Bottom line is, you want to have probably an equal amount in Canada and the United States. I don't know that you should favor one or the other, but better diversification is not to have less in the United States right now than Canada, because the United States is performing better than Canada. The rest of them, the exposures are so small, they're almost irrelevant. So that's the geographical comparison between the case study, the benchmark, and the model portfolio. Easy to see, easy to figure out, easy to understand. How much do you have right now, and how much should you have? in each of those areas. When we take a look at the equity sector allocation, we're looking at how much money is in financial institutions, energy, material, industrials, consumer discretionary, telecommunications, healthcare, consumer staples, information technology, utilities, and other sectors. And I sincerely hope this isn't overwhelming to anybody. It's a lot of information, but it's what the analytical part of my job involves. If we look at financial institutions, we have 35% of the money currently in financial institutions in the current portfolio. It's actually 35.8. In the benchmark, we have a little less, 34.6. In the model portfolio, we have 22.5. We've lightened up on financial institutions by a wide margin. We've increased energy because energy is 17.7 compared to 24.8 compared to 22.1, and this is what it looks like. So at the expense of financial institutions, we've increased the exposure to energy, which is exactly what we should be doing. The rest of these holdings are relatively small. So we have, I don't know how many people are logged on that can see this, so I don't know, I get no way to get any feedback to tell. But if you're logged on, you can see how that works. And it's extremely important to know and understand this. Because if you have too much money in financial institutions, I listened to last week's show when I interviewed Don Nexdorf on the show, and we were talking about having too much money invested in financial institutions, and he said, what's wrong with that? I said, well, what do you think interest rates are going to do? He said, well, I don't know. I think they're going to go up sooner or later. And that's true. And I said, if they go up, is that good for financial institutions? And he said, well, I think so, because they're going to make more money. Well, the opposite is true, because financial institutions borrow money from lenders, and then they lend it to borrowers at a higher rate, and they keep the spread. So the money they borrow from lenders is called inventory. In this case, it's cash. That's what they have to sell. They sell cash. And if it costs more for cash, then they have a profit squeeze. So when interest rates go up, financial institutions don't do as well as when interest rates are level or falling. And I'm not saying there's anything wrong with investing in the big Canadian banks. I'm saying you don't bet the farm. That's the point. So you need to understand that. And you need to design a portfolio that matches up with that. So we have equity market capitalization. I think this is important. If we look at the case study in this particular case, 73% of the portfolio is in large cap companies, 9% in mid cap, 13% isn't identified, and 6% small cap. Well, I think it should be 50% in large cap, 33% in mid cap, 8% in NA, I don't know what that is, and 8% in small cap. I think that's what the mix should be. You should have more money in mid cap or smaller companies, not betting all your money on large cap companies, because there isn't the room for growth there. So, ladies and gentlemen, what do you think about what we're doing here right now? Is this important information for you? Does this help you with your asset allocation? Does this help you understand your financial plan, your investment plan, and how to manage it? The number to call is area code 604-280-0650. The long distance is 877-280-0650. You want to log on, if you can, www.am650radio.com. Click Watch TV. I'll give that out again, www.am650radio.com. Click on Watch TV, and you can watch the show on your computer simply by logging on. Doesn't matter where you are in the world. You could be in Australia, and you could watch this show. Very easy to do. Now, Frida's down at the office for those who are shy or reluctant to talk on the air, for those who want to make an appointment, for those who want a written financial plan, no cost or obligation. Frida's down at the office for your convenience, and you can reach her area code 604-737-3512. That's 604-737-3512. Long distance 800 661-1495. So once again, in this particular case, when we talk about style analysis, the equity market capitalization, that's what we're talking about. How much money is invested in the equity market capitalization? In the case study, that's the existing portfolio, 73% is in large cap. It's too much. You're betting the farm on large cap. The benchmark is even worse. It's 84%. The replacement portfolio recommended would be 50% large cap, 33% small cap, 8%, or mid cap, I should say, 33% mid cap, and 8% small cap. You want to get a second opinion like this on your portfolio? All you have to do is give Frida a call, and you can get Frida once again. You can get Frida at 604-737-3512. If you just tuned in, I'm certified financial planner Fred Snyder, also a registered financial planner representing Scotia McLeod. You're listening to 650 AM. The show is called It's Your Money. And I'm going to add to that how to keep it. Because how to keep it, it may be your money, but if you spend it all, it's not your money anymore. You want to be able to hang on to it. And again, last week we did a lot of talk about not having a deficit. Do you have a deficit in your financial affairs? Do you have a proper budget? Have you talked to a financial advisor about how to eliminate the deficit? How to make sure that at the end of the day you have something left over to save and invest? That's what you need to do if you're not doing that right now. So once again, area code 604-280-0650, long distance 877-280-0650. Log on, www.am650radio.com. Frida down at the office, area code 604-737-3512. That's the most important number of all. I'm going to give it out again, 604-737-3512. She's down at the office, and she's live. You won't get an answering machine. You can talk to her directly right now. Long distance, 800-661-1495. So again, if you want to look at that in a picture, it looks like this. The three bars on the right is what your portfolio should look like, not like the other two. Combination of large, mid-cap, and small cap. That's the mix. So call us. If you want to know what a large cap company is, it's a term used by the investment community to refer to companies with a market capitalization value of more than $10 billion. Large cap is an abbreviation of the term large market capitalization. Market capitalization is calculated by multiplying the number of a company's shares outstanding by its stock price per share. So they're big companies. They're the big blue chips, the ones that have a historical record of high dividend payout. Mid-cap is a company with a market capitalization between $2 and $10 billion, calculated by multiplying, again, it's the same formula. Definition of small cap refers to stocks with a relatively small market cap. The definition of a small cap can vary among brokerages, but generally it is a company with a market capitalization between $300 million and $2 billion. So it's not necessarily what you might really think in your own mind as really being tiny or small. They're substantial companies. We have market maturity, which is another issue that we need to look at. So again, we have in the case study, 98% of the money is invested in developed countries, 2% in emerging markets. The benchmark, nothing in emerging markets. The replacement, 99 and 1. Hardly any different there. No issues there to talk about, really. When we talk about equity style, I think this is really important. Talk about equity style, we have growth, value, blend, and not measurable. But a growth company, those are investors that invest in momentum. If a stock is going up, they think it's time to buy it. If it's going down, they think it's time to sell it. Generally, it's companies that are going to grow, less emphasis on dividends and that kind of thing. Value is Warren Buffett style. If I can buy it for less than it's worth, if I buy it for less than it's worth, if I get a bargain on it and I stay with it long enough, I'm going to make money. A blend is a combination of both. Really, the best style is blended style. So the replacement portfolio puts emphasis on blend more than anything else. Some is often referred to as multi-manager style. So again, another important part of the overall analysis. And bond type is just as important as anything else. Here we have a case study. 25% of the money is in government bonds, 75% corporate. Corporate are shorter-term bonds than government. You got bonds with lower duration, 75%. That's precisely the way it ought to be, or something similar to that. In the replacement portfolio, it's 36% government, 64% corporate. You want more corporate than long-term government, because if you have all your money in long-term government bonds and interest rates go up, you get killed. So this is an example of a case study. I'm going to skip. This is compound returns, annual returns. I'm going to skip the growth of $10,000. This is one of my favorite charts. Okay, so if you can see this, you pick the pattern that you like the most. Here is the case study. $10,000 invested grew to $11,200 over the first 2 years. And again, this is history. This assumes the investor was on board at that time. May not have been. Okay? Second leg of that, for the next almost 5 years, it was flat. That included the recession, $11,200. 5 years later, is still worth $11,200. No performance for 5 years. And then we had a nice little uptick, and again, the portfolio went up during that period of time from $11,200 to $12,623. Pretty flat performance, nothing really extremely exciting about that, so you can see what the picture is. But remember, we're making comparisons here. So if we take the second leg, this is the benchmark. That's how the benchmark compared with the actual portfolio. And again, there's the recession period, pretty flat, worth $14,000 at the end of that period, and it's worth $19,504 today. So a distinct comparison between what the client has right now, $12,623. That's the track record over a 10-year period of time. The benchmark grew to $19,504. The replacement portfolio, by comparison, went up to $14,500 in the first leg. And the second leg, that's the recession period, was very short. And the last leg, very strong. And the client ends up with $20,120. An absolutely fair comparison of assuming the client invested $10,000 back in 2004, made no trades, stayed with it over that entire period of time. If he put $10,000 in each of these positions, the position in the model portfolio was the best with $20,120. So you can see what that's all about. Volatility. This talks about risk. So what's the risk? Well, moderate risk, standard deviation, is considered to be 10. So if I compare everything with that, there's moderate risk. The portfolio's risk, or the benchmark, I should say, is 503, halfway, and the actual portfolio is 5.9, and the model portfolio is 4.01. So here we have the case study. We have the moderate portfolio, we got the benchmark, and we got the model portfolio, which is 4.01, the lowest risk of all. And that's what you want. You want, number one, you got a higher return, but number two, you got lower risk. And isn't this what everybody wants? You want to take less risk and get a higher rate of return. That's what we're looking for. That's what investing is all about. If we look at the best and the worst 12 months, in the case study, there is your best 12-month period of time. You're looking at about 20%. In the benchmark, it's higher. And in the model portfolio, it's a little higher. Not much, but a little. Let's look at the risky side. Case study, the decline was minus 16.3%. The benchmark was minus 23.2%, and model portfolio was only minus 11.1%. So you can compare the model portfolio. The best, it was up, in the case of the model portfolio, 31%, and the worst particular period, that was the year ending November 2008, it was minus 11.1. Best and worst. So that gives you a flavor, that gives you a picture of what we talk about when we talk about a second opinion on your investment portfolio. Okay? And the workshops that I'm going to be doing moving forward are going to be based on this format because it's practical. It gives you something tangible to work with so that you can figure out how to pick your investments. That doesn't mean you necessarily pick them, but you understand the process. You understand how to find the best investments. You understand about how to use Globe Fund or Globe Advisor, ProStation, the tools that are available that are out there. And they are out there. If you got any questions or comments, get on the line and give us a call. This here is a summary chart. It kind of puts it all together in one chart. So there's a grid. And on that grid, we want to see a dot. The best place to be is in that corner right there. Low risk, high return. That's what everybody wants. Good luck. You won't find it. Get high return, you got to take some risk. The worst place to be is high risk, low return. You don't want to be in that corner. This is okay, high risk, high return. That's likely. If you're going to get a high return, you got to take higher risk. And this corner is low risk, low return. So which would you rather have? Low risk, high return, high risk, high return, low risk, low return, high risk, low return. Which would you prefer? Now there's a curved line that goes across that graph that looks like that. That's called the efficient frontier. If a portfolio ends up on that line, it's said to be efficient. A fellow by the name of Harry Markowitz invented this concept back in the 50s. And again, it's called the efficient frontier. Look it up on Google it if you want to see what it's all about. The case study that we just looked at on that chart would be right there. That is the degree of risk. If I go left to right, this is the return top to bottom. It's about 6%. It's not on the green line. It would be efficient if it was up here, but it's not. The benchmark portfolio that we're using as a comparison, it didn't make it either. It's not on the efficient frontier. The portfolio replacement that we recommended would be right there. Now I have 11 model portfolios, and they're all on that line. I didn't put them all in. But I have one here, somebody who can't handle risk. We lessened the risk. We also lessened the return. The return is still better than a GIC. And if we want portfolio 11, which is the riskiest, is still less than moderate risk though, would be up there. And I may add them all on that line maybe today or sometime later, but I thought it was enough to put those on because you can easily see, it's very easy to sum up where the performance is. If you're on that line, your portfolio is said to be efficient. If it's not on that line, it's not efficient. This is called modern portfolio theory. And it's based on past performance. It doesn't mean it's going to repeat itself in the future. Not suggesting that for a minute. So it is Father's Day, and I presume maybe that's why we're not getting an awful lot of calls. I thought everybody would be spellbound by this here particular show today, and it would be spine tingling, and they'd be on the line calling and all the rest of it. I figured that would be the case, but it hasn't so happened. So I suspect that Frida's pretty busy down at the office right now. I hope that you're calling her to make an appointment to get a second opinion in writing on your investment portfolio. This is the format that we're talking about. So again, you can reach Frida, area code 604-737-3512, 604-737-3512. So again, there's additional measurements. When we talk about risk, we got alpha, beta, we got standard deviation, R-squared, Sharpe ratio, all this. These are other ways to measure risk. And you need to determine in your own mind, where do you stand and how does it compare? And the key word is compare. And compare to what? Compare to a benchmark. What's a suitable benchmark that you can compare your investments to? What is a suitable benchmark that would suit your particular investment profile? For example, how much money do you need the day you retire? How much income do you need the day you retire? How much capital will you need to generate that income? How long will that income need to last? What rate of inflation should we use to adjust the income so that it keeps up with the cost of living? I have $100,000 now. I'm 15 years from retirement. Will that grow to be enough to provide me with my retirement income? And what if I don't get there? What happens if I become disabled? What happens if I die? What happens if I get sued? What happens if I lose my business or my job? What are all the risks that I'm exposed to that I need to protect myself against so that I can achieve my financial objectives? Remember that Napoleon Hill once said that anything you can vividly imagine, ardently desire, and enthusiastically act upon will inevitably come to pass. So if you want to be wealthy, if you want to become financially independent, if you want to become more successful financially than you are now, you have to desire, you have to be able to visualize your financial success. You have to want to, and you have to act. You need an action plan. An action plan could very well start with getting a written financial plan. That process could very well start with a phone call. You go to the phone and you call Frida, and she's at the office right now, 604-280, excuse me, that's the radio show, 604-737-3512, 604-737-3512, long distance 800-661-1495. So again, we're talking about your money. We've been talking about your money and how to keep it. How to keep it is the most important part of that. And you will not succeed, you will not achieve your financial profile, potential. You won't get there unless you have the knowledge and the plan, and you work that plan to help you get on track, stay on track, and reach your goal at the end of the day. So it starts with sitting down and establishing well-defined financial goals. I ask this question virtually to everybody that comes into the office and talks to me. Do you have any well-defined financial objectives? 99% of the time, they look at me and they say, no, I don't. Well, how are you going to achieve anything? How are you going to score a goal if you don't have one? Think about that. Imagine playing hockey if there were no nets. Basketball if there were no nets. Baseball if there were no bases. Can you imagine playing baseball with no bases, people running all around the field, throwing a ball at each other? Like, there has to be objectives. So how do you do that? You get started again with a financial plan. No cost, no obligation. MRI on your investment portfolio. You've heard the ads that Scotiabank runs, that you're richer than you think. Get a second opinion. Well, this is what we're talking about. We're talking about a second opinion on your investment portfolio in writing, prepared by a professional. And everybody needs that. You will fail financially if you don't have a plan. Bernard, when he called in earlier, he said, you either plan to, if you don't have a plan, you're planning to fail. That's the bottom line. So get yourself a financial plan. This is your opportunity to do so. And I'm sorry we ran into that little glitch earlier today with this computer. But again, I swear to God, I'm going to sue Bill Gates. But I've seen the same thing happen to him on stage. Okay, he gets on there, he's demonstrating new software, and the computer crashes. Whoa. That's bad news. Anyway, we're out of time. So again, if you want more information, want a second opinion on your investment portfolio, you want an interview with me, just give Frida a call. You can reach Frida right now down at the office. Area code 604-737-3512. Thanks for participating in the show. And to all you fathers out there, happy Father's Day. And we'll see you same time, same station next week. Bye for now.
If you'd like Fred to review your portfolio, call his office right now at 604-737-3512. That's 604-737-3512.